Every disaster movie has that iconic moment. The heroes, battered but unbroken, stand amidst the rubble, surveying the devastation. They ask themselves three vital questions. What just happened? What's still standing? And finally, is the worst over and can we rebuild from here? Monday looked like a condensed version of other market accidents. Certainly not as severe, but a stark reminder it could get a lot worse. The anxiety was with us all last weekend on the heels of a miserable trading week, and then learning that the world's greatest investor, the Oracle from Omaha, Warren Buffett, had thrown in the towel on what is arguably the most loved stock in the last 20 years, Apple. The panic was in the air even before we got to our trading desk Monday. Japan markets had crashed. Europe was deep in the red, and equity futures here in the States were setting up for steep declines. By 8:30 a.m. Monday, an hour before the open, it looked like the S&P would open down between 4 and 5%. Well, the opening wasn't quite that bad, and even though we closed up from the worst levels, the day was bad enough to make even the most bullish investors question their resolve. The panic was with us all week as intense buy and sell programs attacked both longs and shorts. The good news was that each day we put in a higher low. And by the close of trading Friday, it was almost like the week never happened. Is it over? Not a chance, but it's a start. Welcome to The Money Runner. I'm David Nelson. Let's take the market and break it down like a balance sheet. Assets on one side, liabilities on the other. For starters, I put together a chart and overlay earnings and valuation metrics like PE and free cash flow yield. Then we add the risk-free rate. In this case, 10-year yields. Over the long run, stocks follow earnings. And you can see that at least so far, that trend has not broken. Valuations have come in, and maybe more important, falling yields and rising free cash flow are on a course to intersect. All good news. But markets don't crater without good reason. And in this case, there are several. We've talked about a few of them over the last few weeks, but at the top of everyone's list is a rising sense that the U.S. could be headed for a recession. Whether a recession follows or not, the data is troubling and certainly points to less than ideal conditions. Bull markets are not usually led by utilities, and year to date, the utility sector has been battling the communications sector for first place. The flight to safety shouldn't be ignored. Chalk one up for the bears. High yield spreads are widening. It's not alarming yet, but when junk bond yields start climbing against treasuries, markets notice. The next data point is a little more nuanced. Let's look at the unemployment rate over the last 25 years. In a recent research note, JP Morgan discussed the rising probability of a recession when the unemployment rate rises from a cyclical low. If in fact we hit the lows in unemployment, this chart is worth a look. Past isn't always prologue, but it's clear this indicator has a good forecasting record. The good news. Monday's free fall was bought. While we still closed the day down close to 3%, popular stocks like Nvidia found traders willing to step up and catch the falling knives. Traders who bought the open in this AI heavyweight made 10% by the close of the day. The same was true for other tech stock favorites. Apple 5%, Meta 5%, chip stocks like KLAC 8%, Broadcom 9%. Now granted, they were the hardest hit, maybe ripe for a trade, but it does show there are buyers down below these levels. All of the above explains a lot, but the biggest catalyst driving the chaotic trading here in the States? was an earthquake and tsunami building half a world away. Before stocks even opened here in the States Monday, the Nikkei had crashed. Japanese markets fell more than 12% in a single session. Hard to believe a quarter-point rise in rates could cause this much damage. But once traders sniffed out the Bank of Japan was going to raise rates, everyone wanted out of this market. The bigger concern was the unwind of the popular yen carry trade, where speculators would borrow in yen and invest in higher-yielding assets. I'm not sure anyone knows just how large the yen carry trade is, but a team of economists at TS Lombard tried to put a number on it, estimating it at $1.1 trillion. Why should we care about the carry trade? It tells me that leverage is being pulled from the system. Trading in the last few weeks reminds me of when I was running a long-short hedge fund during the financial crisis in 2008. First, I'm in no way saying the economic conditions today are the same, but back then, we saw a similar unwind of leverage. When global funds take down their leveraged exposure, they have to sell the good with the bad. If you're levered up 2-to-1, and you decide to remove that leverage, you have to cut your positions in half. That's a simpler explanation, but likely accurate. When liquidity comes out of the system, big players take down their exposure until the dust settles. I know it's the dog days of summer, with a lot of traders on vacation, but I expect some fireworks next week. We don't have a lot in the way of earnings, but key inflation data hits Tuesday when we get PPI. And Wednesday follows up with the CPI, the Consumer Price Index. And for good measure, retail sales on Thursday and consumer sentiment on Friday. I'm worn out just talking about it. Well, that's it for today. If you like the pod, please hit subscribe. And don't forget my Substack site, DCNelson123 at substack.com. I'm David Nelson, and this is The Money Runner.